Okay, good morning, everyone. Thank you so much for joining our I guess commercial meeting. So today, by the way, this is Radlum Tai from Diamond Residential Mortgage. So I'm very happy to be able to to be part of the meeting today. So today we invited our go-to guy, Mr. Merle Clockey from Anthem Capital Solutions. He's basically an expert in commercial real estate finance, and he does transactions basically on a daily basis, and really, I mean, he's the guy we at Diamond Residential Mortgage. He's the guy that we go to, and somebody we trust to help us with all of our commercial transactions. So it's my really privilege and to introduce him and invite him to speak at this meeting today. So I will go ahead and let I guess Merle introduce himself and get the meeting started. It's all yours, Merle. Thank you.
Well, thank you, Radlum. Appreciate it very much for the opportunity to do this. I'm not a professional speaker or trainer for large groups, but I've done training in the past. A little bit of background on me. I was in the commercial banking business for 33 years, so that dates me right away. You guys are probably pretty good at math, and you'll understand. I left the banking business 6 years ago. And while I was in the banking business, I did manage and operate 3 or 4 branches at a time with 20, 30 employees. And with all the things that go on in commercial banking, had an insurance division, investment division, commercial real estate division, and residential consumer lending also at the same time. And so I kind of oversaw that. Plus, my main purpose at the bank was do commercial real estate finance. And I do pretty much so I've had a lot of experience and been doing it for, pushing, hate to say it, but 40 years. So it gives me a lot of experience to help you that are entering the commercial real estate arena, lending field. My expertise in the last 20 years is kind of what I've been concentrating on, is commercial real estate finance. So that's just a brief background. What we're trying to accomplish today, Radlum and I put this presentation together. It sounds like a lot of you are probably new to the commercial real estate financing. So we're trying to give you a quick overview of what goes on in the commercial real estate side on the lender side. And, the property types that we finance today, we're going to concentrate on as we go through these. My property types, we do kind of everything. I look at office, retail, self-storage, churches, et cetera, car wash, hotels, convenience stores, quick service restaurants is the QSR, Wendy's, McDonald's, that kind of stuff, medical, dental. So pretty much the arena is wide open in the commercial real estate. We look at owner-occupied programs, and owner-occupied is basically if someone owns 51% or will use 51% of the square footage in a commercial building for their business. That's when it becomes owner-occupied. And that's a little benefit. You get a little better program sometimes, a little higher leverage, interest rates might be a little better, that sort of thing. So if something fits in as an owner-occupied, and a lot of lenders, banks, insurance companies, and so forth, credit unions, whoever the investor is, they like owner-occupied. They perceive a little bit less risk. Then we got investment properties, which puts in a multifamily falls into that category. Stated income, that's something that is available. Those are a little tougher to get right now, but that is available. And we do construction, renovation, also. So we kind of cover everything. And so the goal today is to help you hopefully walk away that you'll have an idea of, if you're dealing with the property, to kind of understand the property itself, what an investor and lender are going to be looking at as far as qualifying something like this for finance to get it purchased. There's a few more pictures. I think we can move on with that one. We kind of covered that, Radlam. By the way, Radlam's controlling the presentation, so I'll be kind of cueing him to go here or there as we kind of move through this. I'm not an expert in PowerPoint, but I think we're going to do that. So to start out, we used, what does the commercial lender want to know about the property? So this is kind of after you've been talking to your buyer, seller. So this kind of gives you an inside look at what you can talk about the buyer or seller that you're working with. So you're not in the dark. So one of the first things that we kind of look at is the commercial rent roll, and we're looking for quick data as a lender myself. If someone calls me and say, hey, I've got a $3 million, $4 million property that I have a buyer for, what do we need to get you? So this is kind of the first thing I like to look at is a current, and the big word is there, a current multifamily rent roll. The property we're looking at is a 20-unit apartment building, and with 3 individual investors buying it, purchase price of about $4 million, and the age of the buildings, it was built in 1975. So this is kind of the scenario we're going to walk you through real quick, just to get your feet wet in this. So with that, Rod, why don't you pull up that rent roll so we can all see that real quick.
Okay.
And so, the rent roll gives an overview snapshot of the property. Yeah, expand that. So the basic stuff at the top is, the name, address, number of units, number of vacant units. Right there, we're looking for how many vacancies are there in this property, if any. Right now, a lot of them 0. So a lot of properties right now, apartment buildings are 100% occupied, we're seeing. But that answers our question right away. Number of furnished units, there's some apartment complexes where they actually have furniture, beds, dressers, everything that's not very common, but sometimes it does. But that answers our question right there, if it's furnished or not. And then the number of unfurnished units. So gives us a quick peek of what's going on at the property. And then Section 8 units. Section 8 is, they're getting the tenants are getting help from government programs to help pay their rent. Section 8, if you probably are aware of that since you're in that business. And then the line items is, apartment numbers, and they just fill this out. The owner should have this. Owner or seller should have one of these current at all times. A lot of times they don't. Depends on the sophistication of the seller. But this is what we like to see. It gives us, the unit number, if it has 1 bedroom, 2 bedrooms, 2 baths, 1 bath, the square footage, of status, is it vacant or occupied? The rent that's in place, the date, occupancy dates, the date they, of course, entered the property, when the lease expires, rent increases, and if it's furnished or not, Section 8, and any rent concessions. Rent concessions can be, maybe they gave them 2 months free rent to get into the property, or whatever it may be. It could be a number of things. Maybe their last month of rent's free, something like that, just so we understand. If you want to scroll down on that for me, Rodlam,
Sure.
Details at the bottom of this form, so we get the bottom of it up. So when we're done with this, we know what the monthly rent schedule is, so we know what the gross rent is monthly. Then also if there's any additional income coming off the property. Oh, yeah, I forgot to mention, I'm going to run through this presentation to get through the whole thing, and then we'll circle back, and whatever questions you may have, we'll answer them at that time. So just jot down any questions you may have. You can email them to Redlawn. I think on Zoom, you can type them in or whatever. Then we'll go through as many questions as we have in more details to get you guys all the questions answered for everybody. So the laundry income, a lot of apartment buildings may have laundry income. They may have garage income if there's garages attached to the property. Some of the older properties do have garages, which is a nice amenity. And so we come up with our total gross monthly income. So quickly, the lender, myself, or whoever's looking at this, the commercial lender, understands right away what the gross monthly income is today. And so we can annualize that and start running some numbers real quick. And then the other questions on the side here, which is really important, older buildings, some newer buildings and older buildings, do they have, are their utilities being paid in the rent for electricity, cable, gas, heat, garbage? Newer properties have their own individual meters if they're all individual. So if you're a new tenant, you walk in, you'll be paying your own electric bill, cable, gas, and heat bill. Older buildings, sometimes they have to gross that into the monthly rent amount. So that gets a little more complex when you're, for the underwriter that's backing out expenses and so forth. And we'll get in more detail than that shortly. Are there any rent controls, like in New York City or maybe San Diego, some places, they have rent controls where the property owner can, there's a maximum amount of rent. So we want to know that up front. And if it is, what's the allowable increase per year? And then the other question, what's the average monthly occupancy rate over the last 12 months? We're looking for history on these properties for occupancy. Right now, the last couple of years, occupancies have been really good, 95, 100%. But years ago, they could be down to 70, 75%. So there's a lot of gross income that's not hitting the tax return. So let's go back now, Rodlam, to the presentation. So that's kind of the quick overview. That's a great form for us to look at to get us a good idea what the gross income is. Then we start digging into what the commercial lender wants to see if we're moving ahead with this. We want to see a year-to-date income statement expense report, like through the end of June 2022 is what we'll be looking at today. So we can see, not only after we're done looking at the rent roll, what's actually hitting the books and the expenses. So this data is what we'll be asking the seller to give, and the buyer should want to see all this stuff also, so they can really see what the net operating income is from this building. So we ask for the tax returns for the last 3 years and income statements and balance sheets also, and more heavily on the income statement. Tax returns aren't as detailed as the income expense statements. The income expense statements detail gives us more details on line item for the project. A lot of things get bundled up into the tax returns. So that's what we're looking for from the sellers. And a lot of this information, if someone owns a building, if they own 100% of it in a LLC, they can actually roll that information up into their Schedule E of the personal tax return if they own 100% of the LLC. If not, then usually there's corporate business tax returns, which can be a limited liability company tax return, an S Corp or a C Corp. And hopefully this information is prepared by an accountant, because it's very important to get accurate information. Sometimes we get information that's prepared by the owner that's not trained in accounting, and sometimes the statements are a complete mess. They're not accurate, and thus that can affect the value of the property. Their rent roll says one thing, but what they're reporting to the government is something different. So as a buyer, you want to know, okay, what's the real income from this building? So that's a challenge and things that we work for. So the more current and accurate data we get, the faster we can work on getting an approval for a buyer. Let's move to the next screen. And so the next thing that we're moving into as we gather that data, then we're looking to calculate a debt service coverage ratio. And this is very important. And it's actually done by the net operating income annually divided by the annual principal and interest payments. If you want to pull up that screen for us to dig into, Redlum. And in this is basically an income statement is what it is. That's done on an Excel spreadsheet that I use, and there's lots of different formats of this form. And hopefully Redlum can get that pulled up for us. Any issues there, Redlum? Having a,
I'm here, Merle, sorry.
okay, you getting her pulled up.
The DSCR, correct?
Yep. Yeah, then open that up for us. And so, and if anybody can't see something or whatever, feel free to speak up. If you can't see or hear, we want to make sure you can. So on this particular property that we're analyzing, a 20 unit apartment building, purchase price is $4 million. The gross rents, we're assuming this thing is 100% leased. And I just used $2,000 per unit per month times 12 to get to the $480,000. I'm assuming this property is a 2-bedroom, 1-bath each unit. So I did a lot of assumptions on here just to get this going. The laundry income, $10,000 a year. So this property grosses $490,000 a year. Then the vacancy rate is something the lenders put in. Could be 5%, 7%, 10%, depending on what's going on in the market on vacancies. If the market's soft, they may want to put a 10% vacancy in there. Just, that's for if, there's 3, 4, 5 units that are empty right now. So they're just using average. So that knocks down, the total income using a 7% vacancy rate of 455. Then from there, we just dig in to the expenses on the property. That's why it's so important to get the income statement and tax return so we can see historically what the expenses have been. This is just kind of a generic, what a lot of stuff that we see, normal expenses, advertising, auto cleaning, property management. That's always a big one. If the buyer owner's not managing it himself, is he hired out a management company? Even if he's doing it himself, there'll be a management expense added in there because the lender wants to know on an investment property what the net operating income, and most people are going to have a management company manage this. We got legal fees, accounting, interest expense. When we're analyzing this, we back that out because there's going to be a new loan. So the old interest expense historically is not something that we put in this analysis for the debt service coverage ratio. Once you scroll down a little more, Redlum, for us on this, so we can get to the bottom of the form. So yeah, we move down and we got taxes, insurance, utilities, trash, and CapEx, line item 34, capital improvements. This is something that in investment properties, they put an expense in there per unit, per month, per year to build up capital reserves to replace the boilers, heaters, siding, windows, and all this kind of stuff in the future. A lot of people don't have this in their analysis, and it's something that lenders look at because they want to make sure that they're reserving money to do the improvements when they're due. So there can be reserves set up, not only for taxes and insurance, but for taxes in the future. So that's what that's in there for. So we come up with this, total expensive $129,500. So that gives us a net operating income. So the $326,200 is what's available to service the debt on this property. So I used over to the right there, $3 million loan, 75% value. That's the leverage normally on commercial real estate investment property. Sometimes we get to 80%. In this case, I used 75% or a loan amount of $3 million on a 25-year amortization, a 5-year fixed rate at 5.75 today. 90 days ago, that probably would have been 3.75, but the market's cranked up. P&I payments are $19,026 a month. So that times 12 gives you the $326,200. So, excuse me, it gives you the $228,312. And to get your debt service coverage ratio, you divide 326,000 by 228, you get 1.43. The standard ratio, what lenders, a minimum amount, it should be at least 1.25 times or higher. So and what that's really showing us, if the borrower's got $1 in debt, he needs to have at least $1.25 in income coming. That's kind of a simple way to explain that. So that's how we look at quickly to test. This is the first year, on this particular presentation, I just did 1 year. Now we'll analyze if we got the information for the last 3 years, we'll dump all this in there and the year-to-date information so we can see what the ratios will look like. 1 year they could be great. The previous year it could be 1.1 or 1.1, which they're not. The numbers are too tight, so we'd have to find out what was going on in those years. So that's your debt service coverage ratio analysis and what lenders are looking at. This is a lot of information you'll probably never get dug into, but at least you've got a good understanding of the why the lender wants to dig into this stuff. And then we also we'll do a projection. If the income's low, we'll look out, what are the market rents today? Is this property underperforming? So maybe our gross income is $480,000, but maybe the seller of this property, the rents should be $2,500 a month or $3,000 a month, whatever it is. So there could be a lot of room, what we call upside. And that's why this investor wants to buy the property. So we'll dig into that stuff, through the appraisal and talking to the realtor, and the buyer. Say, okay, the market rents are $2,000, or they're paying $2,000 a month right now. Is that under market or over market? That's a very important thing that we want to understand. Okay, let's go back to the.
Merle?
Yes, sir.
Hi there. My name is Xavier. I had a question pertaining to the DSCR.
Sure.
And, as I was watching you go through that cash flow, my assumption is that that's for like a multifamily financing, right?
Right. That's the scenario we're using. This is a 20-unit apartment building. Yes.
Okay. Yeah, that's good. And I also assume that that's like more for a stabilized type of asset. But what are lenders looking at as far as the DCR and, let's say, like a bridge type of financing scenario?
It can depend. If it's a bridge loan, then those are looked at a little bit differently, because on a bridge loan, it's a short-term credit. What's going to happen with the bridge loan? Is someone going to buy it, renovate it, and flip it and sell it? Or
yes, exactly.
Yeah.
Exactly.
So I tell you what. Let's get through this first, because I'm sharing a scenario on a purchase of a 20-unit apartment building right now. And then when we get to the questions and answers, then we can dig into a little bit more of that. I want to get through all this first, and then we can dig into that, because that's another, that's why commercial real estate finance is pretty complex. There's lots of different scenarios and different things to talk about. But let's get through this first, and we can come back to that. But basically, to answer it quickly, is that if someone is doing a bridge loan, we got to find out what the bridge is for. Are they buying it, renovating it, and going to keep it? Or are they buying it, renovating it, and going to sell it? So if they're going to buy it, renovate it, and sell it, we're looking at, one, the absorption. How fast will this thing sell as soon as the renovations are done and it's ready for sale? So and when the market's been hot, we know that if they get it, assume it's a office building, it can be anything. But if it's a renovation and they're going to flip it, then the bridge loan, that's what bridge loans are used for. Then the biggest concern is going to be, okay, what's the cost to get it upgraded? Is it going to appraise for the purchase price plus the renovation cost? And then the sales price will be X. And that's the exit of that loan, is that once it's sold, it pays off the bridge loan, if it's a flip. Now,
right, exactly. And that kind of brings in another question as to like how lenders are viewing loan to cost currently. But, again, that's kind of diving deeper into this type of scenario.
Yeah, exactly. Let's hold those off till we get
into the questions and answers later.
And then we can review all the questions on different types of properties. But for this one, I just want to get through this scenario on a 20-unit apartment building fairly quickly, because I know
sounds good. Sounds good.
Time goes fast talking about all this. So number 4, the location. A lot of commercial real estate investors, they want to finance properties when that cities that have at least a population of 50,000 people. which in California, that's not a big deal, but and I do stuff nationally. So if I get out in the Midwest at small towns, you could be at 5,000 people. So then you got to find different investors and so forth. So, but the big thing is the neighborhood, crime rates, access to the freeway. These are all things you guys know. Fire protection. Where's the fire department? Is it a mile away or 10 miles away? Flood zone. A lot of people think, well, we're not near water or anything else. But as you guys know, if you got a little creek bed in the backyard, if there's a big rainstorm that stops over the top and dumps rain 6 inches in a day, you can have issues there. Environmental issues. I want to go through this document. This is something that people never ask questions about. When you're buying a commercial property, even an apartment building, are there any environmental issues, not only on the subject property, but nearby? Is there a gas station up the hill, down the hill? Is it near an industrial park and stuff? So can there be environmental issues within the circle of this property? If you can pull it up real quick, Red Lum, on that one.
Sure.
This is something, and just kind of scroll down. But I'll just go over this, and we can spend a lot of time on this. But this is really an important thing. A lot of times it's not an issue, but if it is, it could be an expensive issue if there's environmental issues. I had a property. It took almost $1 million to get it cleaned up. It was a small retail strip mall out in Colorado, and there was a dry cleaner in that property. It was an older property, probably built in the 60s. And so these are just a number of questions you can kind of go through. So we can come back and go through some more detail if we have time, but it's drilling down on, has this property ever had any environmental issues? PCBs, and like an old laundromat back in the 50s and 60s, they used some really harsh chemicals to clean clothes. And those things, and that's what was in the subject property I was financing. And this guy had to not only clean it up, he had to monitor it for like 5 years. With and there's 3 scenarios you go through on commercial real estate. If it's a low risk property, there may be what's just called a desk review. And in a desk review, it costs $500, $600, $700. The environmental experts will review all the city, county, state records or federal records on that property. Has there ever been a previous contamination or issue on this property or nearby? And if there is, then they have to go what's called a phase 1. And the phase 1 is boots on the ground. They come out, and these guys that are environmental engineers come out and look around, testing, maybe dig a little hole with a shovel, and are looking around for more issues and sampling the topsoil, basically. If they find anything there that causes more issues, then you go into what's called a phase 2. A phase 1 can cost up to $2,000, $3,000. If they find stuff and they want to do a phase 2, then it's not going the right direction. That means they're finding issues. Now they bring in a small drilling rig and they start drilling down 5-6 feet and testing the soil in multiple places to see if there's other issues going on. That could be, another $5,000, $6,000, $7,000, $8,000, depending on the complexity. So environmental is very important. Always ask your seller, even in an apartment building, have there ever been any issues? There could be a tenant that brought some, we've got all sorts of drugs and all sorts of stuff. So you want to know, even if it's a multifamily, if there's garages on site or stuff like that, has there ever been these issues? And that's why we have the buyer seller fill out these reports to give us an idea of that. Condition of the property, the year it was built, how old's the roof, heating system, all these things are buyers and sellers want to know. Capital improvements over the last 5 years. Have they put in a new roof, new boilers, new windows, all those expensive things? We want to understand the condition of the building. And because when we get to the appraiser, the final amortization of a loan or structure of a loan can depend on what's called the remaining useful life that the appraiser calculates into a commercial appraisal. And so if a building's been around a long time and it hasn't been maintained well, the amortization can go from a 30-year to a 25 to a 20 or even a 15-year amortization if the building has not been kept up well. Size of the property, we're looking for a lot of details. One of the best ways for you working with someone, ask the seller, if they've got an old appraisal we can get. The market information is not going to be any good in it, but all the square footage calculations and all the details of the property itself, we can look at it and get a really good, to get our arms around it as fast as we can of this property to move our approval process along. And what kind of amenities? You've got pools, clubhouses, garages. I know that some of these newer apartments, they have bars in them and everything else. So we really are digging into to see exactly what type of property we have. Okay, you can go to the next screenshot there, Rodlin.
Sure. By the way, so at the end of the presentation, Merle will be able to share a copy of the this slide and also any documents he uses during the presentation with every one of you. So
yeah, you guys have copies of all this stuff that we're looking at, so you can keep it for references later on. Property management company, that's always important. If we've got, like in this case, this is a multifamily property we're analyzing today. So we want to know if there's a property management company, who is the company, how long they've been in business. And so we want to, if they have a website, or whatever they've got. So we really understand that they're a good, experienced property management company. They're going to take good care of this property. And the buyer wants to know that, whoever he's going to hire. But we also want to know who's been the property manager in the past. So if they're a good property manager or not. The utilities, and we spoke briefly about this, and you can pull up these pictures as I'm talking, Rodlin, but on the newer multifamily buildings, they have metered, every unit has its own meter, which is really neat for underwriting, because they'll pay their own water bill, they'll pay their own electric bill and their own gas bill for heat and air conditioning. And so this is really nice. So all the tenants are paying directly to the utility the expenses. If you don't have this in older buildings, everything is done with one meter for the electric, one for the gas, and one for the water. So the owner of the building has to prorate it for each unit. And so if your neighbor leaves his lights on all day and takes a 30-minute shower, you get to pay part of his utilities, right? So it's nice to have your own gas and meter. So we're always, looking at this. Here's a nice one. This kind of almost looks like an older building with that bricks and so forth, but that has all of its. This looks like it's a 14-unit property, and then there's an extra unit or an extra gas meter, and that's usually for the common area, for the hallways, the parking lights, and stuff like that, or the heat for the common area. So you'll have one for the common area. So that's good to have. The leases. As we move through our underwriting process, we want to get a copy of leases. Sometimes we don't require them, and sometimes we do. It depends on how comfortable we are with the property. Because on multi-unit, multifamily, these leases are expiring, within a year all the time, because most of the leases are for 12 months. Sometimes they're for 24 months. So a lot of times we don't get each and every lease on a property, but we do want to get a copy of the lease format, so we understand that it's in compliance with all the local, state, and federal laws. Because there's a lot of that stuff that's changed over the years. We want to make sure that's good. Estoppel document. If you want to pull that up real quick, what that is, the lender and buyer, Estoppel is a form that the tenant will fill out. And basically, this is actually confirming that what the lease states is what the tenant understands he's paying. So we want to make sure, that if he's paying $2,000 a month, he should be writing in number 3 that he's paying $2,000 a month right now, and he's current. So this just is a quick, if there's 20 units, every client or tenant gets one of these, and they got to fill it out and give it back to the owner so he can present it to the lender and the buyer to confirm that all the information in the rent roll and all the data that we're confirming is correct. Apartment loan questionnaire. You pull that's another form you guys can look at. There's a lot of detail. We could spend 40 minutes talking about all this stuff, but this this gives you a good idea of what not only the lender, but the buyer wants to know about the property. Management, the improvements, a lot of things we've talked about already in this property. So you can read through that in detail, and we can go back if you have questions on that. But it just gives you a really good window of what the lender is going to be looking at. These are great forms, and not all lenders use these things. A lot of investors I work with, and some of them have a shorter version, a longer version. So, but it really digs down a lot of information so the underwriters can understand, who's the seller, who's the buyer, details about the property. So, so we can move on to the next one. Commercial appraisals. This is important. This is a lot different than residential appraisal that you guys may have, folks have been using. On a commercial appraisal, they usually take 3 to 4 weeks to be completed, depending on what's going on in the market right now. They're right in that 3 to 4 weeks or more. An important thing in commercial real estate, the appraisal is not ordered at the time of the application. I know in the residential world, you guys have computerized approval systems where they type in all the data. It's fairly simplistic when people are buying a home. If they're W-2'd or whatever their tax returns, they can punch in a bunch of information into the computer and get an approval, and they order the appraisal the same day. On commercial, it doesn't move that fast because we have to gather a lot of information and do some pre-underwriting to make sure this deal is going to work. Because we order an appraisal, like an appraisal on this property, it would probably be $3,000 to $4,000 or $5,000 on a 20-unit apartment complex. So there, and then we have to order. We have to get a survey, and we have to get an environmental report done. So we've got a lot of costs that we don't want to hit the buyer with. So that's why it takes a little bit longer before we start ordering a bunch of appraisals. Now, if the client is in a big hurry and he wants to put cash on the table for all these reports, we can order them quicker, faster. So, but when we look at when these appraisals come back, I don't know if you've ever seen a commercial appraisal, but they're usually anywhere from 40 to 100 pages long or more. I just had one done on a 47-unit senior living apartment complex in Anaheim, California, and that was pushing 200 pages long, and that appraisal was just under $6,000. And the 3 approaches that we see in these, they got the market approach where they're using comps of like properties that have sold. Cost approach is what's it going to cost to build this today, which is very important. And this number is just all over the board today because of cost of labor, materials. You guys have heard all the stuff in the news. So when they do if we're doing new construction, like we're doing this 47 units, a $12 million construction project, the costs are jumping $100,000 a month over the last 6 months, just because materials, everything is going up. So it's kind of a rodeo doing new construction right now with these uncontrollable costs. The income approach is the one in investment. Most commercial real estate, we're looking at the income approach. Because that's what's going to service the debt on the loan. So that's when we get into the net operating income and what we've already seen. So that's usually the holy grail, because the market approach can be a lot higher than the income approach. And the cost approach can be higher than the income approach because it costs more to build it. So, but the income, that's the cash flow. That's what repays the loan. So that's what most commercial real estate lenders are looking at. Okay, let's move on to the next one. I think I'm going to fly through this stuff because this is stuff you probably have seen before. Personal financial statements. Again, we like to collect last 3 years in everybody, tax returns, and credit scores, all the kind of basic stuff. This is when we're underwriting the guarantors of the loan, because most of the main borrower is going to be the entity, corporation, LLC that owns the building, and these are going to be we're looking at partners' information. So we're looking at the same stuff now as a residential loan, but we want details when they complete the 1003 or personal financial statement. We wanted 100% completed in all sections because we're looking at everything. I know the residential once you guys verify enough assets to approve the loan, you're done. But in our, we got to verify everything, every asset, every liability. So I think we'll pass on that debt schedule because we're already pushing the clock on this. So let's go to the next screen. Again, same thing. I've got a form. You guys can look at that on your own. Rather than send you this stuff, but it's just my detailed checklist of everything I ask for, tax returns, et cetera, et cetera, et cetera. So it's just a checklist of stuff that we gather. I'd recommend you look at it because it's a lot different things we ask than what you would in a residential package. So let's go to I think the last item is the title information. And the thing that we dig into also is while we're doing all of our other underwriting and the financial and partners and all this other stuff, with my experience, I like to dig into the title and the property right away. So when we get it under contract, I like to get the title company involved immediately to get us a title commitment so we can find out, is the title clear? Are there any liens out there that we don't know about, encroachments that would require a survey? So we like to get that thing ordered immediately so we make sure we got clear title. Because I've sat where people don't pull a title commitment until we're 2 weeks from closing, and all of a sudden there's a lien on there. We don't even know what it is, and it could take us a month to get it resolved. And I've had that happen where someone had filed a lien on the property. It was an error, but it took us 2-3 weeks to get it removed so we could get to closing. So it's the same thing with residential. You guys like to get those things, so get those orders right away. So if there's a problem, you can start working on that while the appraisal's ordered and all the other reports are being done. So that's, and the other thing on commercial real estates, if you want to drop down a little bit more, scroll down some more, Adlam, is when you're doing a contract on commercial real estate, I always tell my commercial realtors, do the contract for a 60-day close minimum. And you really need to understand the type of property because, it can take, I've worked on commercial loans for 6 months before they get closed because there's all sorts of things going on. So you really need to be in contact with a commercial lender, what's going on with the property, who the buyers are. I did a large hotel construction down in Denver a couple of years ago. We had 8 different guarantors on the loan, all partners. So not only are we underwriting the property itself, but now we've got 8 partners to underwrite all their information, and all these partners all own their own businesses. So we had to underwrite all their own businesses and their personal financials. So it gets very convoluted and a lot busier than a residential project. So that's why it's always good to be talking to your borrower, buyer's lender to understand how complex it is going to be and how many days do we need to put in that contract for closing. Because 30 days doesn't cut it. 90% of the time, you're going to be going back and forth and getting extensions. So it's always better to get at least 60 days or more. And the big ticket is we can always close early, when the deal's ready to be done. Because this is not a primary residence that someone's moving into or moving out of. So it's a commercial deal. So once we get all our stuff, if we're ready to close in 35 days, we'll let them know, hey, we're ready to close. Let's do it. So, but it just they're certainly more complex. So with that, we got through that. So let's open up for questions. There was some out there, so I went.
May I have a question regarding your environmental survey? This is regarding the retail centers, shopping centers, not regarding the apartment. Okay. And in this particular property, we already got the no further action letter and all the survey back in say 10 years ago, and we got a brand new phase 1 indicated the clean, but this I won't say brand new. It's say 2 years ago. As a lender, do you require to update the phase 1? Is not a question, but do you need to redo the phase 2 again?
Yeah, good question on the environmental reports. it's going to depend on what type of property was this? Is industrial?
No, it's a shopping center.
Shopping
And
center. Okay.
they do have a dry cleaner.
Yeah, if they got a dry cleaner on there, the first question is going to be asked, are they actually doing the dry cleaning in that?
On site. And that reason why they have
On site,
say
okay.
no further action. They did all the survey, did everything about 10 years ago. And then in 2020, we got another clean phase one. So if we want you to do the financing to provide the clean phase one, or maybe brand new phase one, is not a problem. But do you require to redo the phase two again?
No, what we're gonna gather first is, as an underwriter, is that we're gonna gather up it's why it's so important, always tell your commercial owners, buyers, sellers, keep all of those old environmental reports. If they go back 30 years, keep them.
Yeah.
Because the first thing we're gonna do, how long ago was that last phase two done?
Mm-hmm.
And the longer it's been, and if they're still doing dry cleaning and so forth, it could require another phase one or phase two. But the more data we have to show that, this business has been operating state certified, and so the chances of any more contamination, because a lot of the newer dry cleaners are operating with stuff that's not even contaminants anymore, I'm told. Mm-hmm. So it's not a big issue, but it just depends on how long that dry cleaner was in that building. Has it been there for 20, 30 years? Because they were using PCBs back in the 40s, 50s, and 60s, and that stuff, because they look at it parts per billion, and it can take 30 years for that stuff to break down by itself.
Yeah, I know. So, that's the reason why, if we have.
Yeah, so the answer to the question, always gather up all the environmental reports the seller has, the owner. And so because we want to look at them and give them to the experts in that field. And hopefully they'll come back and say, you know what, we're good. We just need to do a little desk review for $500-600, and I think we'll be fine.
I see.
Or they're going to come, they're the experts, the environmental gurus. And we give that to them and they look at it and tell us, do we need more reports, more investigation in this property or not? Hopefully not. Our goal is to not have anyone pay for more environmental reports.
Yeah, makes sense.
And most properties are fine. But when you get into more industrial, like dry cleaning is a big one. And if anybody's using cleaning solvents, your repair shops, gas stations, stuff like that. If it's a gas station, we're just gonna have to require one.
Oh yeah, that is a must. Yeah, the next question is regarding you mentioned about the occupancy. You are looking at the historical data, say 3 years. Now, past 3 years, you got a pandemic. So this kind of occupancy is probably not reflect the market, as of this year the rent spikes. So how do you make a judgment? How do you use a lot of pro forma or something like that to do the judgment of the income?
Yeah, we try to use as much common sense as we can. So that's why when we're looking at the historic numbers, we know that 2021 pandemic, coming out of the pandemic, is that a lot of the apartment buildings, depends on what area you're in and what kind of clientele you have. But most of them we've seen so far, they really didn't have any big issues with delinquencies. And some do, but we look at that. If we see that the rent, that's why when we get the historic tax returns, income statements, we can see the dips in gross revenue. And so we see that there's probably been vacancies. So we talk to them and understand why. What happened with your vacancies? Did the pandemic hit you hard, and why? And so we understand that. Then did they get any PPP funds from the government to help support that? So we'll add that back into cash flow. And our goal is to try to make it work and get it closed. So we're looking for why are these numbers different, or what are the issues and what happens, so we can analyze it and hopefully make it work.
And last of it is regarding Estoppels. Sometimes the owner send out the Estoppel certificate and cannot always get these back. I know on industrial, sometimes, or some retails, you can provide the owner's certificate of Estoppel Do you accept that?
Well, it can be up to the buyer also,
Mhm.
what does the buyer want and what does the lender want? And, sometimes, if there's 20 units and we get 17 of them back, it's a pretty good test that things are probably okay. So it's going to be the lender's underwriter's final decision. Do they need 100% of the Estoppel form signed? Probably not. If they send out 20 of them and they get 15 back and all of them are accurate to what the leases say, and the other reasons the other 5 didn't come back because they're on vacation, they're traveling, or they're sick, or whatever, it's not going to kill the deal.
Okay. Okay.
It's a
Now,
test.
Yeah, the appraisers, do you need to use the MAI?
Usually, yes. Yes, they got to
Okay.
be a full certified licensed appraisals.
Okay. And probably, I hope this is the last. What kind of program do you offer? Where is your source? Are you a direct lender, or do you go to the insurance company, pension fund, or even labor unions in all those areas to get a loan?
Sure. Yeah, I'm a broker. After I left the commercial banking business, when I was at the commercial bank, I can only offer them, my clients, one bank's products, and that was it. And after doing that for many years, and I wanted to get away from the corporate structure and the compliance and issues with the commercial banking world and get my life back a little bit. So now, as a broker, I work with multiple banks, insurance companies, credit unions all over the US. So I work for the borrower buyer, and I pre-analyze their financial package. I talk to the buyer, what he's trying to accomplish, what he's doing. And if we want to move forward, then I gather their financial package. I send them out my checklist of information. They send it to me securely through ShareFile, which is an encrypted system. I know Diamond Residential uses that also. Then I pre-underwrite it, and I know if it's going to work. And then I'll send it out to 3 or 4 of my top investors that I think would like this program. And then I get my client, 2 to 3, 4 offers back and pick the best one for them.
Oh, I see. Okay. Yeah, and so usually you don't, you as a broker, you charge point.
I'll charge an origination fee of, depending on the size of the loan. It's a good question because my minimum loan amount that I work with is $500,000. I don't like going.
Yeah, I know.
Yeah, and then so I charge a minimum fee of $5,500, and then 1% up from there. As the loan gets larger, like when I'm doing one for $10 million, then there's room to negotiate, right?
Yeah, you're right.
So I try to get a 1%, and a lot of my investors, since I bring them a full package pre-underwritten, so the lender will usually charge a minimal fee because I've done most of the work for them up front already.
I see.
So I negotiate that, with my buyers and lenders and give them an estimate of what my fee is going to be, the lender's fees and appraisals, everything we need, so they understand up front.
I see.
Full
Do you
disclosure.
still handle the conduit loan?
Pardon?
Conduit.
Conduit loans?
Yeah.
Yeah, I have
That-
sources to do those if need be. Those are expensive loans to put together, but if it's a big group of investors that want to do it, we have sources for that too.
I see.
Merle,
Okay.
Merle, do you also have access to joint venture equity capital sources?
I really, the private guys, I really don't. If you're looking for private money, joint ventures like that, I really don't have access. I'm mostly doing with institutional lenders.
Got it. Okay, and you also work on like Fannie Mae executions as well?
Sure. If we got a deal that needs to, a big apartment building or something like that, that the borrowers want to do a Fannie Freddie, we have a lot of my investors will do those also.
Okay, is there any more questions for Merle?
Oh yes, regarding bridge debt. What are you seeing? What are you seeing as far as DCRs and loan to cost and recourse versus non-recourse? Can you kind of speak to those details?
Sure. Most of your commercial real estate loans, no matter what property type, unless it's a large loan in low pretty much all of them are going to be full recourse, personal guarantees. Very seldom will lenders do them non-recourse. Now, if you get with an insurance companies, they're okay with non-recourse, but usually it'll be at 65% loan to value or lower when they're looking at non-recourse. So if you're trying to get higher leverage up to 70%, 75, 80%, it's usually recourse. So that's why I just tell, it's always good to prompt your borrowers that it's probably going to be recourse unless you're at under 50%, whatever. So recourse is tough to do, especially now in the economic conditions. Getting to your bridge loan, the bridge loan purpose is really important to looking at what ratios we need. If it's just going to be a fix and flip, the lender's still going to analyze and want to know what the debt coverage ratio is going to be on that particular property. Because if the property doesn't sell, if the market turns on the dime, and this happened after 9/11, I had a huge project in Colorado as a $10, $12, $14 million high-end condominium project. We had 50 of them pre-sold when we started the project. And, the market was good and they had huge earnest deposits on, $50,000, $60,000 earnest deposits. When 9/11 happened, every one of the contracts, the buyers walked away from their contracts. So on a fix and flip, even though it's a fix and flip and it's going to be a sale, the lender is still going to test the market. Okay, we get this thing built, this absorption, they should be able to sell it within 120 days after it's done. Boom, the loan gets paid off. But the lenders still do an analysis. If the market turns, now you've got to rent that property out because it doesn't sell. They're going to be looking at the net operating income again. So they're still doing a long-term cash flow analysis, even though it's a fix and flip. If you're looking through banks, credit unions, and insurance companies, because they still want to understand if they get caught with this property because of the market and all the crazy stuff we've seen going on in the last 5 years in this country and nationally and globally, everybody's preparing for more than, if this fix and flip doesn't sell, how much rent are we going to get to make the mortgage payments? So, and then if you've got a bridge loan where somebody needs to buy a property quick and get it renovated and stabilized, and they're going to keep it long term. So then we're looking at a bridge loan to get it purchased, renovated, and then we flip it into a permanent mortgage loan. So we're still looking at the same ratios on the back end, fix and flip. So a lot of the underwriting is the same, even if it's in fix and flip. The leverage ratios, if it's a bridge loan, it depends on the quality of the asset, where it's at, who the guarantors are. You can still get maybe 75% on a bridge loan. It just depends on the who, and that's what's so different about commercial real estate finance. If you call me and ask me for a rate on something, it's really impossible for me to give you a quote on an interest rate because there's so many things I need to understand. The risk, the risk underwriting versus a residential property versus commercial is just completely black and white. They're so different. All I can do is give you a range. And that's a good thing I want to kind of wrap up with is pricing is kind of a guideline if you just kind of want to know yourself. Is if you look at a lot of lenders are doing treasuries, they use the T-bills, the 10-year, 7-year, 5-year, 3-year treasuries. And today, or actually yesterday, the 10-year was at 3.1, the 7-year was at 3.11, the 5 at 3.14, the 3-year at 3.27. The shorter term rates are higher, so we're into an inverted yield curve, which indicates recession. I'm sure you've heard all this on the news. And most lenders, when they're underwriting commercial real estate, are going to charge another 200 to 300 basis points over those treasury terms for an interest rate. So that would give you kind of a ballpark to start out with. And then from there, you just have to look at a massive information like we've been discussing to really come up with, where do we think that this spread's going to be at? What's the margin over the T-bill going to be on this particular project? I did before the rates cranked up, I did a 103 unit bridge loan, permanent, of an old apartment building in Fort Wayne, Indiana. It was built in, I think, the 1940s, and nothing had been done to the property. the original owner died, his kids took over, and they just kept taking all the money out. The thing, they run it into the ground. Let's say that. My buyer came in and bought it for 2.6 million. He had to put 4 million in to get it up to speed. So we ended up with a renovation loan just under $9 million, purchase renovation loan. And the borrowers, the property was a piece of crap, but these guys had a lot of money, and my guarantors had, $30 million liquidity between them. It was a no-brainer on the underwriting side for the guarantors. The property, though, was not in good condition, so they, of course, had to spend $4 million to get it fixed up. But the whole thing worked out really, really well. With that deal, because the principal's guarantors were so strong, I got him a 10-year fixed rate at 3.5%, and this was a year ago, for the renovation loan, bridge loan, and it automatically converted to a permanent loan after they got the property fixed up. So, the rates can be very different, same type of property, but different condition, different borrowers and guarantors. So that's why it's very hard to get a quote on a commercial real estate loan. You can get a range. That seems going to be in here somewhere. So that's why when I work with the Red Law and Diamond Residential Mortgage loan officers, the only thing they have to do is give me the name and phone number of the buyer borrower, and I'll get on the phone with them right away and see what they're doing, what's going on. Because you see the massive questions I need to answer. It's just, I need to get on the phone right away with the buyer so I can see what he's doing to assess the situation. I can ask, with my experience level, I can ask a lot of questions over the phone and understand if I can do this or not and what the rate's going to be roughly, just by asking, 50 questions in 20 minutes, because there's a lot of information.
So yeah, so I guess we have to come to the end of the hour, and does anybody have any more questions, or is there anybody else? Maybe last questions for Merle before we end the presentations. And again, you have access to the slides and the documents Merle has been using, for the presentation. So you'll be able to reach out to Merle directly if you have any, specific scenario. Joe.
Yeah, all my information, contact information is on there. And I apologize. I knew I'd feed you what I used to call a fire hose. All this information I've talked about it. I went through it fast and furious because I wanted to give you at least a good idea. And then you'll get all my documents and so forth. You can kind of read through theirs and so forth. But it'll be enough to give you a good understanding now, hopefully, of what the back end commercial underwriting is looking at and why. So it helps you, be more professional when you're talking to your prospective buyers and so forth. And that, hey, you're going to need this, and this is why. So it makes you stand out in front of, because a lot of times when we get commercial requests, I always know if I'm working with someone that understands it or they don't on the commercial side, because it is much different. So this at least gives you a quick understanding, and you've got some materials that you can refer back to. I would recommend saving those, and you can go back to the environmental report or the apartment questionnaire form and read through those. And it's really good for your understanding too. So if there's no other questions.
Yes, I believe that's it. Merle.
Yeah, I appreciate everybody's time, and hopefully I didn't overwhelm you, but call me anytime, shoot me an email. We can answer any other questions you may have. And if you got a deal you're working on, be happy to talk to you about it if there's some issues going on or whatnot. And appreciate it very much.
Awesome. Thank you so much, Merle, for attending. And this is really great presentations. And hopefully we'll be able to bring you back again next time for maybe stuff, right?
Sounds good.
All right. Thank you so much, everybody, for attending. And we'll look forward to to seeing you all again next time.
Thank you. Have a great day.
Thank you, Merle. Take care.
Thank you.
Radland